Hi there, welcome to Neppy Invests. Every single time I start preparing a video, I have these preconceived ideas about what I want to talk about, the most important ideas, and maybe some points I want to get across, those sort of things. And on occasion, this happens rarely, the end result is a little bit different from where I started out. And that's definitely true in this video because when I started preparing this video, it wasn't about talking about the power of compounding, wasn't about a stock fight between Telstra and CSL. The topic I want to discuss originally for this video was all about this confusion around letting your winners run versus taking profits, because I have talked about both of these ideas or these concepts. In fact, I have mentioned we should let our winners run, but at the same time, I on occasion will take profits when a company I do own, the share price has taken off. And I just wanted to clarify why I use or when I use both of those concepts, letting the winners run or taking profits. But as I started going down this road, this path of preparing the video, I realized there was something much more important than differentiating between letting the winners run and taking profits. And that was all about the power of compounding. And this is one of the most important concepts in investing. And that's why I really wanted to talk about that concept in this video. And in fact, I'm going to show you an example of how compounding is such a massive thing as an investor and why I tend to invest in growth companies, not income companies. As I started down the journey of preparing this video, I was thinking of possible titles, and originally the first title was going to be all about letting your winners run versus taking profits. But as I progressed further down that road, I realized this video was talking about why I personally invest in growth companies instead of income companies. But as I moved even further down the road towards the end line, I thought the most important concept that I was bringing up in this video was all about patience and how important patience is as a long-term investor. But when I finished the video, I realized the most important concept I was bringing up in this video was about the power of compounding. And in my opinion, the most important concept to grasp as an investor is the power of compounding. If we understand why compounding is really important to understand, we can also understand why letting your winners run is one of the best strategies to have as an investor, why investing in growth companies is probably better in the long run than investing in income companies, and why patience is one of the most important qualities to have as an investor. And if we understand all that, we can bring all this together. And then if we understand all these four little concepts, we become and can become a much more successful investor. In this video, I'm going to talk about two types of companies. One type of companies I very rarely invest in, and these are mature companies. These companies tend to have really good dividends, but their capital gains or the share price appreciation of these companies are fairly small, non-existent, or maybe even the share price goes backwards. Examples of these sort of companies are Telstra, Woolworths, their banks, even some of the mining companies like BHP, Rio Tinto, those sort of companies. I very rarely invest in these companies unless I do see some good value when compared to historical values of these companies. So I have actually invested in the banks before. I've invested in Telstra, Woolworths, but typically I only own these companies for a short period of time until the value gets back up to normal levels. These sort of companies have very little growth. For instance, if we look at Telstra, revenues in 2006 were 22.7 billion and revenue in 2021 was 21.6 billion. Very little growth over a 15-year period. And then you look at the share price. Back in 2006, the share price was between about $3.50 and $4. And in 2021, the share price has been between $3.20 and $4. Again, very little growth. The whole reason people like to invest in these sort of companies is simply because of the dividend. But there is a flaw behind that investing strategy, which is what I am going to discuss in this video. The second type of company I want to discuss in this video is, in fact, my favorite sort of a company to invest in. That is growth companies. And when I talk about growth, we're talking about revenue increasing through time, profit increasing through time, operating cash flow increasing through time. So you get these big capital gains, because if all those metrics are growing through time, more than likely the valuation and the share price of these companies will also grow through time. One of the main reasons some investors don't like to put their money in these growth companies, apart from they think they might be overvalued, is simply because they have small dividends, and they prefer to put their money into companies which have a nice dividend yield. But there is a flaw behind that, and again, I'll talk about that during this video. Examples of these growth companies include CSL, realestate.com, and Nick Scali. I've held CSL and realestate.com in the past. In fact, realestate.com I held for over 10 years and recently sold out. That could be a mistake. And CSL was one of my biggest investing mistakes, because I held that at about $30 to $60. And when the share price doubled, I decided to sell out, and the share price has increased fivefold since when I sold out. Again, let your winners run. That's a great example of me personally not letting one of my winners run and not benefiting from compounding. And the main notable thing about these growth companies is increasing revenue. You can see CSL has grown their revenue from $2.8 billion in 2006 to $10.3 billion in 2021. And because this company is growing, we know the valuation and the share price should grow with it. So the share price of CSL has grown from between about $15 and $20 in 2006 to almost $300 in 2021. That's more than a 10-bagger in a 15-year period. And that's why I like to invest in these companies, because of that capital gain. I'm actually fortunate enough that I don't really care about dividends much at all. I do prefer capital gains, and these are the sort of companies that are attractive to me. Now, to show you why I personally prefer to invest in growth companies over income companies like Telstra, I'm going to show you an example and give you numbers, lots of numbers in terms of the returns you can expect when you invest in growth companies compared to if you invest in income companies. So let's go back in time to 1997, the 17th of November that year. Why is that date important? Well, that is the date that Telstra listed on the ASX. In fact, I do remember that date quite well, because so many people were excited about investing in Telstra. They thought this was a great company to invest in. Now, in this hypothetical situation, me and my friend have to make a choice. I don't know why we have to make this choice, but we can either buy 10,000 shares in Telstra worth $27,000, or 5,000 shares in CSL, which would be $29,200. Telstra opened on the 17th of November at $2.70, which was a premium to the IPO. I think it was a 30% premium it opened up. And CSL opened on the same day at $5.84. So let's see what's happened if we both decided to maintain our holdings in these companies over the past 24 years. And I'll just show you the completely different sort of returns you can get if you invest in growth companies versus income companies. Now let's just imagine that back in 1997, I am quite naive about investing. I don't really know anything about the topic. And I decide that I should put my money in Telstra because of three reasons. First reason is it has a better dividend yield, about 5%, I think it was about 5.2% in fact, versus a 3% dividend yield for CSL. So I can get more money from my investment each year by the dividend. I'm loving this investing in Telstra because of this nice 5% yield I'm getting from investing in this company Wow, why would I not take that instead of only getting a 3% return from CSL? It's also cheaper. Now, I know that's false logic because the value of a company isn't determined by its share price. It's actually determined by its market cap. I'm not sure what the market caps of both companies was, but I just see the Telstra share price is $2.70, CSL share price is over $5, so Telstra is the cheaper option for me. And who the heck has heard of CSL? I have heard that you should only invest in companies you know about, that you've heard about. And everyone's heard about Telstra, and this was all the rage back in 1997, November. Everyone was talking about it. This was the best IPO the ASX had seen for many a year. This was going to be a raging success. Why would you invest in anything else other than Telstra? Now, when it comes to my friend in 1997, my hypothetical friend, he's actually much more like I am right now because he's done a little bit of research on these two companies and has decided to put his investments into CSL rather than Telstra for three different reasons. The first reason is he believes CSL has the best chance of growth over the next few decades, and he prefers to invest in growth over income. And because he prefers to invest in growth over income, he doesn't really care about dividends. He doesn't care about the dividend yield. Even though CSL has a dividend yield of 3% compared to Telstra's of 5%, it's all about the future. It's all about the fact that CSL's dividend could grow through time. And the third thing is he just wants to beat me. He wants to do something different than what I'm doing. And he believes that CSL is the better investment over the long term. So now let's see how both of these investments have performed over the next 24 years. Before we have a look at how both investments did perform over the next 24 years, CSL actually did do a 2-for-1 stock split in March 2007. So my friend now, instead of having 5,000 CSL shares, has 10,000 CSL shares, the exact same amount of shares as I have in Telstra. When it comes to the total returns of our investment, we have to take into consideration two things: dividends and capital gain, which is the share price appreciation of that company. That might seem a simple concept to some investors, particularly experienced investors, but some people don't understand that total returns relies on both of these investing aspects. The first thing we're going to do when we look at the total returns for both of these companies, if you invested them back in 1997, is look at the dividends these companies have given to their shareholders over the past 23 years. Back in 1998, the dividend total were fairly similar for both companies. CSL had an 18-cent dividend while Telstra had a 14-cent dividend. But the most notable thing you can see from the dividend history for both of these companies is how CSL's dividend has increased at a very consistent rate, almost year-on-year increase in dividend. In fact, dividends has increased from 18 cents to a current dividend of $2.94. Now, I've included the effects of the stock split. So even though it says $5.88, when you take into account the stock split, that's what it is. In fact, the dividend for the past year was only $2.94, but you've increased your shares in this company by double. So that means, in effect, your dividends have also increased by double. So dividends has continually increased for CSL. Same thing can't be said for Telstra. In fact, dividends have actually gone backwards. They did increase for a period of time, but over the past 3 or 4 years, dividends have fallen a fair bit for Telstra. We'll have a look at fallen dividends for Telstra in the next slide. But that's the main thing you can see here. And this is an effect of buying into or investing into growth companies. You will see the dividends grow through time. But if you invest solely in income companies, there is a possibility the incomes will go sideways or even fall through time. And that's an important reason why I like to invest in growth companies over income companies. Now, I've broken down the dividends per year for me and my friend. In the first year, 1998, I received $1,400 for my Telstra dividends, and my friend received only $900. I was laughing at him that whole year because I had a better return from my investment. In fact, my dividends in Telstra exceeded CSL's dividends, or my friend's dividends, up until 2006. In fact, Telstra dividends and the amount I've received actually grew from 1998, 1,400, to 2005, and I received 4,000 of dividends in that year, while my friend only received 2,850. But from 2005 to 2021, my dividends that I received from Telstra fell from $4,000 per year to $1,600 in the 3 most recent years, while my friend from Telstra has seen his dividends increased from $2,850 to $29,400 each year. Now remember, his initial investment in CSL was $29,200. So right now, the dividends he is receiving from CSL exceeds his initial investment in the company. That's just amazing. While my dividends is only $1,600 compared to my original investment, which was something like $27,000. So he's received, my friend has received significantly more dividends from CSL than I have received from Telstra. So let's have a look at the difference between the dividends received over the past 23 years. I have received $60,100 in dividends from Telstra. That seems a fair bit. I'm really happy with the amount of dividends I've received from Telstra until I asked my friend how much of dividends he has received from CSL over the past 23 years. And then he tells me he's received $239,169. That's 4 times as much dividends from CSL than Telstra. And just remember, the whole reason I invested, or one of the reasons I invested in Telstra, was because of the higher dividend yield. And it did have a high dividend yield back then. But because CSL is a growth company, the dividends have just increased year on year. Well, Telstra, who pays out most of their profit each year in dividends, hasn't grown. It's gone backwards. And in fact, the dividends they have given to their shareholders over the past 3 years is the lowest ever they have given to their shareholders. And this is one of the reasons why I invest in growth companies. So just looking at dividends alone, it's pretty clear that investing in growth companies, CSL, would have been much more preferable than investing in Telstra back in 1997. You just had to be patient. You have to let the compounding take effect by investing in that growth company. Now let's have a look at the capital gain investing in Telstra compared to CSL. And this is where the difference between investing in growth companies compared to income companies is absolutely amplified. Now, I invested 10,000 shares in Telstra, and on the 1st of November, the Telstra share price was $3.92. So my 10,000 shares in Telstra is worth $39,200. That's an increase of $12,000 over 23 years. That's not really good capital gain growth at all. In fact, that's quite pathetic. It's probably less than 2%. Now let's compare that to the worth of my friend's 10,000 shares in CSL. Now let's have a look at the value of my friend's holding in CSL. If you remember, they bought 5,000 shares originally back in 1997. There was that stock split in 2007. They now have 10,000 shares. Current share price of CSL, 1st of November 2021, is $306.58. You don't have to be a wizard in mathematics to know that my friend's holding in CSL is going to blow the value of my holding in Telstra out of the park. But just how far out of the park? Remember, the value of my holdings in Telstra was $39,200. My friend's value of his or her holding in CSL is $3.1 million. Enough said. Now to the power of compounding, the whole point of this video. And what we're going to do here is look at the compound annual growth rate in the share price of Telstra versus CSL. This is referred to as CAGR. So if you ever see me use the acronym CAGR, I'm just looking at the compound annual growth rate in something. In 1997, share price of Telstra was $2.70. And even though I'm saying the share price of CSL was $2.92, we had that stock split. So it was actually $5.84. But because of that stock split, you've increased, or you doubled your share holdings in that company, which means the share price in a relative sense was $2.92. Hope that makes sense. Share price now in Telstra is $3.92. Share price in CSL is $306.58. Total gain in the share price of Telstra is 45% from 1997 to now, and the total gain in CSL is 10,399%. That's a lot, but let's break that down in a year-by-year growth in the share price. And if you do break that down, the CAGR for Telstra is 1.7% per year. There has been share price appreciation for Telstra since 1997, 1.7%. It's not a lot, but it's still an appreciation. For CSL, the share price has increased at 21.4% per year. That does not seem too high now, does it? In fact, my main goal as an investor is a 20% increase per year in my portfolio, and I do gain that each and every year. And the reason that is my goal isn't because of CSL. It's simply because I want to double the market returns, because a lot of the best known, most famous investors out there have received or given their investors, the people who have trusted them with their money, returns of 20% per year. Some experts out there, some professional and private investors have returns of 30% per year. And CSL has given their investors 21.4% per year, which is very achievable if you put your time and effort into your investing strategies. And the value, again, repeating this, of Telstra Holdings from their original investment, $39,200 for me and my friend, $3.1 million. And that's the power of compounding. That should show you why I like to invest in growth companies over value companies. Sure, Telstra originally had the better dividend yield, but because CSL is the growth company, eventually the dividend for that company and the dividend yield for that original investment completely blew Telstra out of the water. And this, again, I just have to keep repeating this, is why I invest in growth companies. Now to the true power of compounding. I'm hoping this table will really show you why compounding is one of the most important concepts when it comes to investing, and also why the rate of return on your investments is highly important. And also why I personally don't buy ETFs, because I am not satisfied with market returns because of the different end result if you do put the time and effort into your investing strategy. So I'm breaking this down into 3 different scenarios. And just imagine you have $10,000 to invest in. You can either put your time and effort into investing strategies and get 20% per year, or just put your money in an ETF, don't have to worry about it, 10% per year. Or someone comes up with this other solution, low risk return or low risk investment that's 5% per year. You think you are a risk averse sort of investor and you don't want that possibility that your capital will be wiped out. So you're happy with 5% per year. I'm not sure why you would choose that at all when you could choose ETF, and that's fairly low risk. But let's have a look at the power of compounding. I've broken this down into 5-year increments. After 5 years, 20% per year, $10,000 has turned into $25,000. 10% per year has turned into $16,000. And the 5% per year has turned into $12,700. After 10 years, 20% is up to $62,000. 10% per year, the ETF is at $26,000, and 5% per year is at $16,000. And then we really start to see the effects of compounding. 15 years, 20% is up to $154,000. 10% per year, the ETF up to $42,000. 5%, your safe investment is up to $21,000. And then again, compounding takes effect. 20% per year after 20 years is up to $383,000. The ETF is up to $67,000. Your safe investment is up to $26,500. Then after 25 years, your 20% per year investment strategy is almost up to $1 million. Your ETF, your value of the ETF is just above $100,000, and your very safe investment, 5% per year, is up to $34,000. And then between year 25 and 30, you can really see the effects of compounding simply by looking at that 20% per year difference. The returns in that have gone from just under $1 million to $2.4 million. In fact, Warren Buffett has stated that the majority of his returns has happened in the last 20 years since he's turned 65. He started investing when he was something like 14 years. So the first 50 years of his life, the returns he got in those years is nothing compared to the returns he has received over the past 20 years. And this is why the power of compounding. Even the ETFs has the returns of that have gone from 108,000 to 174,000, while your very safe investment value of that has increased from 33,000 to 43,000. And this is again why I like to invest in growth companies, why I like to stock pick, why I don't like to invest in ETFs. And I do believe we all have the potential to get 20% returns per year. This is definitely achievable for all investors out there if they put the time and effort into their investing strategies. That is all I have for this video. We're talking about the power of compounding, why I always say let your winners run. Now, saying let your winners run only is or pertains to certain companies. And those companies are growth companies like CSL. There's other companies that I don't believe you should let them run, take profits. And I will do another video on that. If you do have any questions about this video or any concepts I've raised in this video, please leave your comments, your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need to seek financial advice, make sure you find someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.